Over the past few years, there have been major changes and complexities surrounding the advisor M&A and transition category. What was once a simple process and there was a lot of demand has now become a lot more complex, given the advent of what happened with Silicon Valley Bank and First Republic, as well as a lot of advisors having a challenging time bringing their clients over from one firm to another. All of these require many factors, including having a very systematized organic growth strategy, understanding the legality behind how to transition, succession planning, and much more. Because of these complexities, I thought I'd bring my friend from the industry, Louis Diamond, to join me in answering many of my questions that are not only on top of my mind, but also on the mind of many of my clients. I hope you enjoy the conversation and let me know if you have any questions. Okay, well, welcome to our channel today, Louis.
Thanks for having me, Amy. Excited to talk with you.
Yeah, I'm super excited to have you on as well. We've obviously crossed paths a lot of times. We're in the same circle with Advisor World, you on the recruiting and M&A side, our firm on the client communication, marketing, and sales. They definitely go hand in hand, as you know. I would love to just get a quick bio and update about you and your firm, what specifically it does for those who may not be familiar.
Absolutely. Appreciate the question. So when we were talking about this offline, Amy. We're a fully run family business here at Diamond Consultants. My mother, Mindy, founded our company about 27 years ago. And my brother works with us, so does my father. And we have about 15 people out of our headquarters in New Jersey and New York City. But we work with financial advisors nationwide. We really do one thing. It's fairly simple. We represent financial advisors, regardless of their channel of affiliation, whether they're at a wirehouse, they're already independent, they're IARs of an RIA, they're at a regional firm, et cetera. We'll help them, we say, live their best business life. And that means arming them with education on all the different options available to them, helping them really think through strategically what they're looking for, what's best for them, what their business needs. And then when they're ready, we have over 400 different firms that we work with. So we'll be their consultant in sizing up which organizations or platforms or modalities are the best fits for their business. So folks come to us as kind of a one-stop shop instead of being reactive and responding to a random voicemail from a firm's recruiter or talking to XYZ firm because my friend went there. It instead starts with it starts in a very strategic, thoughtful way with what are you looking to solve for, and really getting down to what's going to be best for the advisor, and then guiding them throughout the process, kind of like an investment banker would. But in our world, we're helping folks change employers, launch independent businesses, change platforms, and at times we'll also do some M&A. So it's I think fairly simple what we do. It's very focused on experienced financial advisors, but as you know, there's a lot of opportunity and a lot of complexity within our world.
Absolutely. So you work with 400 firms. I dabbled a little bit with recruiting because some of my clients were asking, hey, can you help us go to another firm? And then I know that we had to get engagement set up with the different firms in order to become a recruiter for them. Doesn't this cause a little bit of a challenge for you guys? Because like, let's say one firm you have a contract with, and then you want to take another advisor to another firm. How do you guys balance that as far as in the ethos of the advisor recruiting world?
Yeah, it's a good question. So I guess my job as president is to have the most expansive solution set or platform in the industry, and I think we do. So it's not that we're placing advisors at 400 different firms every year. It's more that we have to be familiar with all the major players within the industry. The way it typically works is we have open engagements or open contracts with all these different firms. We're never on retainer or have any sort of expectations that we're going to actually help that firm find advisors. It's more so we have relationships with advisors. we scope out what's the best fit for them, and then we'll make targeted recommendations that make sense. It's a fully contingent model, meaning we're paid by a firm or a platform or a custodian if only if we're able to facilitate a transition to that firm. Instead of being on the buy side, which is, hey, I'm calling on behalf of XYZ firm and trying to jam everyone into the one organization.
Yeah, absolutely. So you're really the client, the advisor's your real client.
Exactly.
Goal is to move them to different places and see where they fit. How do you choose that? How does an advisor know if a firm is their calling or where there's a good fit? What have you seen as some of the top criteria advisors have when thinking about changing, besides the obviously the financials and the compensation?
Right. Yeah, the financials have to make sense. It's actually fairly rare that we work with advisors who are solely guided by the economics. The economics, unfortunately, are the probably the only objective measure to gauge a firm, payouts, deals, etc. The rest of it is fairly subjective. I would say the criteria somewhat depends upon what type of firm an advisor is moving from, but typically, regardless of channel, it boils down to freedom, flexibility, and control. Advisors wanting to maximize or optimize those three verticals. So it could be freedom to market myself and to express my views in a unique way. It might be compliance is down my throat and I want to be able to maneuver with less limitation. It might be I want to work with international clients I'm not able to. Just as like three just high level examples, but typically advisors on the move are looking for those three areas, and that's kind of what's frustrating them at their firms. And then it gets into, of course, technology and product platform, and what's the focus of the firm, what's the business model, what's their transition success, how do they help me in transition, what and ultimately what's going to be in it for my client for making this move. So the criteria varies a lot, but to keep it very simple, freedom, flexibility, and control tends to be the holy grail.
Yeah, well, those all sound really great for the advisor. Now let's talk about the client because we've seen some situations, as you may have as well, where the advisor chooses to go to one firm because they had that freedom, flexibility, and freedom. And what was the third one? Freedom
Control.
and control. But their clients may not necessarily follow suit, and they may, say, "That sounds great, Louis, that you've went from our large wealth management firm to the small one. It sounds like you have a lot of control, but we'll stay here." Have you seen and situations like that, or times when things didn't go as the advisor expected, and what lessons you learned in advance to that?
Yeah, so yes and yes. So most often, the advisors we work with will move 85 to 90% or more of the target clients within 3 to 4 months of the transition. The numbers typically are much higher if it's an already independent advisor and they own the relationships and they own the data. But for the most captive of advisors, so advisors that are with non-protocol firms, they're with one of the major wirehouses who will fight like hell to try to retain client relationships. 85 to 90% is a fairly conservative estimate of what's going to come. In this business, you know this, and you help your clients develop this. It's about the relationship and it's about trust. And typically, advisors or clients will follow the advisor and follow that relationship. It's not always the case, but almost always an advisor is making a move because there's tangible benefits to the end client. If clients don't move with that advisor, it's either because the advisor didn't do a good job of articulating the benefits. Sometimes there could be proprietary products or just a very long-standing, let's say, banking relationship, or hey, Goldman is taking my company private and I can't move. There's sometimes things like that, but most often it's because the client doesn't follow because the relationship wasn't good and it's probably not going to be a client for long anyway, or the advisor doesn't articulate the value proposition. And that's even at a time when many companies are offering free fees for a year to try to entice clients to stay. So saying, hey, your advisor just left to go to Raymond James, as an example. When we try to keep those clients, tell the client we'll give them free advisory fees for a year. So it's kind of like try it out for free. Even with that, you would think that would attract a lot of clients. It honestly oftentimes blows up in the firm's face because, again, the client's loyal to the advisor and they'll sometimes see through that tactic as gamesmanship. But sometimes folks are attracted to it.
Yeah, absolutely. I mean, that's where the whole value proposition, storytelling, articulating your message is really critical. We've done that for a lot of advisors that didn't do it when they should have, which is
Right.
before they did the transition. And now they
Right.
are, the clock is ticking with their new advisor and nothing is happening. So they are, potentially hiring us to help with that value proposition and story. But when do you think is a good time to start planting the seeds? If you think you do want to transition, should you be taking your clients out to dinner, lunch, and
Right.
explaining this, or should you be doing it after? But then what if it gets back to your,
Yes, you have to be careful because of employment agreements. One of the things that is completely off limits is pre-soliciting client relationships, unless you're independent. If you're independent and you read your IR or your registered rep agreement, and you do in fact own the business, own the data, et cetera, it's still a little bit risky to do that, but you can certainly be more forthright and transparent about what you're doing ahead of time. And we've actually seen some transitions we've worked on where the advisor is independent, they're actually able to pretty much complete 97% of client paperwork. They left off social security numbers and client signatures. And even before they resigned from their broker dealer, they were able to at least message to clients what was happening. The flip side of that is if you're employed by a firm, regardless of who it is, we would always advise, an attorney certainly would, to be completely quiet about the concept of moving. If you ever mentioned it ahead of time, it's known as a pre-solicitation, which is against broker protocol. It's against all kind of employment agreements. What we have seen that is a little bit of a risk, but tends to work pretty well, is if an advisor has, let's say, one or two like really key relationships that they feel really strongly about, and ultimately will only move if that individual is on board, they may say something like, "Hey Joe, I just wanted to check something. You know, I always operate in your best interest. We're called frequently by a number of different organizations who would love for me to bring my business to them, and we're always just looking out for what's in your best interest. If one day, hypothetically, I decided to move the team to another organization, is that something you would consider?" You can kind of do stuff like that. It's still a little bit of a risk because you can't say where you're going to go to, and it may open up Pandora's box. But there's some things around the edges you can do, but you really have to trust that the client isn't going to bring this up to a firm. And we've even seen some firms like that are really good at this, where a manager might get on the phone and innocently ask a client, "Hey, like, did you know that Phil was looking around?" And a client doesn't really know differently. They're like, "Oh yeah, he told me at the golf outing a couple weeks ago," and
oh
then they could
my
have an
gosh.
issue. So there's things like that you should avoid. Typically, better safe than sorry, and keep quiet until the very end, even though it's more stressful and you're catching people by surprise.
Yeah. Do you see a lot more opportunities for advisors who are on the large wirehouses or even, the independent broker dealers to go to another similar looking firm or to go independent? I guess, and in addition to that, where do you see the future of the advisor world? Is it more on the wirehouse side or is it more independent, mom and pop shops starting their own firms and growing? Where's the biggest growth opportunity? Where are the clients happiest? And where have you seen advisors successful after that
Yeah.
transition the
So
most?
a lot to answer there, but the simple answer is I think everywhere there's opportunity, and we honestly don't see one channel or one firm that is leaps and bounds ahead of everyone else. It really starts and ends with what an advisor is looking to solve for, what's important to them, and what's their mission, what's their vision, and what's gonna feel fulfilling to them. For many, it's I'm a big firm. I'm a big firm guy, and I like the name on the business card. I like the scaffolding. I like that I don't have to take care of running the business, and I'm very successful here. Maybe it's not here. Maybe I need to go to another firm to live my best business life. But they like kind of staying in channel. We do a annual survey or data analysis of advisor transitions. Anyone's welcome to download it. And in 2022, we showed that more times than not, an advisor who transitions is going to remain within their industry channel, meaning they're going to go from wirehouse to wirehouse or independent to independent. Looking at our business is kind of a microcosm for the industry. We're obviously only a small subset of all the activity, but we have a relatively decent amount of market share. We're about a third of the moves we facilitate are wirehouse to wirehouse. About a third are some sort of captive model, whether it's a wirehouse, a private bank, or a bank of some sort, to a more boutique type firm. So whether that's Merrill Lynch to Raymond James, or RBC, or Rockefeller, or to what was First Republic, those types of moves. And then another third will break away. So they'll go from either independent to independent. They'll go from wirehouse to RIA, wirehouse to independent broker dealer. So we kind of see any and all as possibilities. I call it job security. That there's so much complexity in the space, and there's new firms and platforms that are emerging in all the various industry channels. And quite honestly, I don't think there's a right answer for where clients are going to be happiest. I think there's advisors that do a better job at making sure their clients are happy, but a good advisor isn't unique to one channel of the industry. Sometimes an advisor feels they need to change firms or change affiliation models to really flex the entrepreneurial muscle and really deliver the type of advice they want to. Maybe they're constrained by, but I think that's more on the individual rather than an indictment on a certain channel of the industry.
Yeah, oh, I could not agree with that more. If you're an advisor who, who's great at managing clients, you'll make it, whether it's at a large wirehouse or RIA. In fact, even though 90% of our clients are RIA and about 10% on the wirehouse side, I would say be careful what you ask for. If you want to be an entrepreneur, be ready. Website
Oh, yeah.
changes, collateral, you're no longer a household name. Um, that is going to be a huge budget that you should be putting aside. Typically, it's about 5% of your revenue is the KITSIS analysis,
Yeah.
be the minimum. And remember, you're going from a large wirehouse that everyone's heard of, right? A
Yeah.
Merrill Lynch, Goldman Sachs, those are household names, to RIA. So even though I love and I'm very passionate about the RIA world, I think a lot of people just think it's cool to go on my own, but they
Yeah.
underestimate how much work it is to rebuild that brand visibility, and that therefore you become solely reliant on client referrals and so forth.
I agree with you.
Yeah.
It's yeah, we do a podcast series where we interview many advisors that have broken away to go independent, and like it's hard to draw generalization of what makes the most successful breakaway advisors, but almost always they had a vision of what they wanted to accomplish for clients or what they wanted to do to their business that was just not achievable in any sort of captive environment. But you have to be a special type of person to think that way. And you have to really have that burning desire to go out there, market yourself, put yourself kind of on the front lines and do things differently. And for many people, they're not looking to do that. You give up a lot, like you mentioned, some of the things if you go independent. You're giving up a massive check to go to another firm. You're giving up a safety net of turnkey infrastructure. And even though there's a ton of different platforms and service providers that can help an advisor get from here to there, it still doesn't solve for the fact that you're the entrepreneur, you're the CEO, and you have to have the vision and execution to go out and build something special. And like as a shout out to firms like yours, you don't have to know how to do it all on your own, but you have to be self-aware enough to ask for help and outsource the things that you're not best at. And I don't think any financial advisor is best at knowing how to market themselves. They may know how to tell their own story, they may have some ideas, but creating a website and a brand story and a transition story, and finally the shackles are off. Now your bio doesn't have to be in size 11 Helvetica font and say these things, but that can also be pretty scary. And advisors have to really lean into what it means to be a business owner. And I think that's why folks like you are enabling the ecosystem to thrive.
Absolutely, and yours as well, because I know, as I said at the beginning, I'm a serial entrepreneur. I love entrepreneurship, and my brain just cannot stop coming up with ideas. So that's why I said, "Oh, let me try this recruiting part." Since so many advisors that we have as clients, we do coaching for them. They ask about, what do you know about the recruiting channel? And yeah, kudos to you guys because I know that's a very specialized type of effort and skill set and network that one needs, in addition to the legality of it. I mean, the laws, like protocols, and how do you talk to your client, solicit, and
Right.
things like that.
I feel like we know how to talk the talk on legal, but we will never give legal advice. We have a
Yes.
number of attorneys we would that we refer to, but we have to be knowledgeable about that type of stuff.
Absolutely. And then speaking of businesses, I'm fascinated by you guys' family business because the business was founded by a woman, your mom. So I'd love to hear the dynamics of that as well, how it was to grow up in a family where the mom was the CEO and founder. I know my
Yep.
kids have heard every single story of every single client, every single teammate. So it's I love raising them in that environment. But I think it also relates to what's happening in the industry with so many mother and son, father and son businesses, and advice you want to give them as they are now taking over what their parents built. What lessons have you learned that you could share
Mhm.
with those advisors?
No doubt. Yeah. So it was honestly an underrated and underappreciated gift growing up around any business, but especially diamond consultants. I never expected or thought that I would come into the family business, but it was by far one of the best decisions I made in my life was to come into this business. Growing up, my I saw my mom build this company from legitimately a legal pad and the yellow pages on her bedroom floor into the leading recruiting and consulting firm for financial advisors in the country. So seeing that was a pretty cool gift just to see like nothing was given to her, how she built it, what she did to make it happen. I feel like I had a leg up with understanding terms like trailing 12 and unvested deferred compensation. And I knew a lot of like branch managers' names randomly. But I think the biggest thing was just seeing the entrepreneurship and what she built, and seeing that you can't take anything for granted. That like truly like everything was earned and worked for, nothing was handed to her. So that was amazing to grow up with. And we do translate a lot of our learnings from our own family business to how we counsel teams of advisors. More and more often, we are, to your point, seeing the father daughter, father son,
Yeah.
mother daughter type dynamic, or even brother in law, sister in laws, etc. Family businesses, honestly, are they're some of the most in, the most engaging to work with because you're dealing with a lot of different personalities. But the really interesting dynamic is when we're working with a family team, they 100% of the time are thinking longer term. They're looking at the business as a business and they're thinking beyond just the next 3 to 5 years. So you see that kind of play out. Many of the wirehouse firms have retire in place programs. So we'll give you 2 times your revenue if you transfer the business to so and so on your team. You do this, and you'll be out in 5 years. That's a very popular option, but most often family teams see that as not the best option because they don't want to lock up their kids for a number of years, and they're potentially leaving the business in a less than ideal spot. So when we get to work with family businesses, we're able to think about independence where that may not have been an option before. We're able to even think about, okay, so XYZ firm works for you, dad, for the next 3 to 5 years because anyone can grind it out for 3 to 5 years if you know you're going to have millions of dollars on the other end of the rainbow. But if you're thinking about the next 15 to 20 years for where your son or daughter is going to be best, is that where you are now? So it's amazing to get to work with family businesses. It's not without its quirks. I know sometimes there's a bleeding over of family into business. It's impossible to extricate the two from one another. But we're lucky in our family, all four of our core family members are in the business. We're all still really close. We're all really good friends. And there's some arguments, but we're also able to invest in one another. And we're much more committed, I think, to working together than a traditional a management team would be.
Definitely. Two more questions before
Yeah.
we sign off. The first one is obviously, I just want to get an update from you on what's been going on since 2021, or I guess late 2020. There was a
Mhm.
huge buying frenzy with PE firms, with low interest rates at that time, just going crazy and really boosting the values of some of these companies. And since then, we know interest rates have hijacked to
Mhm.
extreme levels. So I want to hear how that's changed, the M&A activity within the advisor world, but also adding to that, the crazy dynamics we went through earlier this year in 2023 with what happened with First Republic Bank and Silicon Valley Bank, and some of these banks going bust that were huge recruiters at that time. So would love to hear how the dynamics have changed of late in the advisor recruiting and M&A world. Did that scare advisors away from doing any transitions? Are advisors stuck with where they are? Any updates you have there?
Yeah, so I'll take it in two parts. So the first one on the M&A side. So there's tons and tons of articles. This isn't anything unique that valuation spiked. In large part, it's because there's an imbalance of there's a supply and demand imbalance
Yeah.
between all of these firms looking to acquire and a lack of available quality firms that are looking to transact their business. By our count, there's over 45 discrete private equity sponsors, it's probably more now, that have invested in at least one RIA. And pretty much every single one of those platforms has the same playbook. We're investing in a quality firm that's scalable, has a good management team, but we need to go and buy firms underneath it in order for the value to keep rising. So that is still playing out today. There's still a massive, massive appetite for businesses, even with interest rates going up. We haven't seen multiples go down, but I think similar to the housing market, we're not seeing them rise by 15, 20, 30% like we did the last few years. So, if anything, it's kind of a return to normalcy. It was probably necessary because there was only so much room that the multiples can really get to before just kind of, I guess before the music stops. So, I think it's probably a healthy thing that the multiples haven't gone up as much, but it has forced some potential sellers to wait it out. I mean, the market's been cooperative this year, but the market didn't do so well last year. So that kind of pulls some people back. And no one wants to make a bad deal or have seller's remorse. So we've definitely seen some folks punting on a sale, maybe considering an internal succession deal as a stopgap measure, or just repositioning or retrenching before their business value increases. And then the second part of your question was on
Add
first.
one thing to that, Louis. I think it's really important for both the buyer and the seller. On the private equity side, if you are going to go buy a business, make sure you understand what is the organic growth model
Mhm.
for this firm that you're buying. The numbers may look attractive today, but as those families die off or retire, the assets are in attrition. How is this firm going to grow? And so I think there would potentially be buyer's remorse. And on the seller side, I wrote about this in RIA Biz a while back. If you're going to sell, make sure you're going to be familiar with some of the pressures that now you're going to have to be beholden to around growth, right? A lot of firms are really happy being service models and being, customer service focused. Now, if you have a private equity backed uh, stop, you're going to need to showcase growth in a different way, in a
No
different
doubt. Yeah,
trajectory.
and it's organic growth net of market appreciation.
That,
That's what firms look for, and part of the answer to where multiples were and kind of the feeding frenzy was there's articles that are always written about the median multiple or so and so has a friend who sold his business for 12 times. But what's important to know is not all multiples are created the same, and just because your business might be a similar size, multiples are really determined by what's the organic growth rate. Many other factors too, but how quickly a firm grows, what's the repeatable process for growth is probably the most important thing a buyer would look for, and something that
absolutely.
advisors should focus on as they're leading up to a sale. It's focusing on building that process and building that funnel so that you have impressive data to show.
Yeah, we've worked with a few firms right before the year that they sold, where we did extensive sales consulting and coaching and building their business development model. So they had something to show to the firm that this, everyone on our team has been trained around sales. Otherwise, you're not gonna, inorganic growth is not going to count based on what you're saying. So that's
Exactly right.
really important.
And Amy, you asked too about First Republic, which I could hit on briefly. Yeah, it was a crazy, crazy couple of months. I think it was
Yes.
March and April, because pretty much the entire industry grinded to a halt. Most transitions we had going were either put on hold or deferred. I mean, we had some clients that were going to join First Republic. Obviously, that didn't happen. But also just many financial institutions, even Charles Schwab and LPL, were in the headlines, and unfairly so. But there really wasn't a corner of the industry that was unscathed. So it was kind of a scary time. Luckily, it was relatively quick. But what we did see was First Republic in particular was probably the most aggressive bidder for larger teams, and they were a really attractive home for the right businesses. They were very selective, but they really worked and kind of filled a unique void that's now kind of left. So it, I think, does have an impact on recruiting, but many other firms are stepping up. And typically, when there's a will, there's a way. If an advisor is motivated enough to make a change in this environment, they're going to find a model that likely meets their needs. So maybe they would have gone to First Republic before. Maybe now it's Rockefeller. Maybe it's let's start an RIA. Maybe it's relooking at Morgan Stanley or UBS. So it's more competition is good, especially when it's such a high quality firm. But we're still really bullish on the options for big teams. And if anything, it's a readjustment, and everyone kind of learns from prior mistakes. So now folks ask more questions about balance sheet and doing more homework on the underlying firm. And we're also asking advisors more often about how important is it to be with a firm that has its own balance sheet versus being more in a family office model, which RIAs employ, which is shopping the street and not being beholden to one lender and a single custodian.
That makes a lot of sense. Yeah, those checks were extreme. Do you think those advisors regret it, and do they have to give the money back? Just out of
I don't
curiosity.
know. I mean, there's probably some that regret it because a lot of the advisors that joined First Republic did so the last few years. So they just got through a stressful transition, and many were put right back into the process, really out of the blue. The way it works with any recruiting deal, it's different with an acquisition, but a recruiting deal, it's a time bound forgivable note, meaning it's a 9, 10, 11, 12 year forgivable note. Each year you work, let's say, tenth or 1/12th of the note burns off. So for any advisor who's joined in the last few years that left, they would have to pay back a prorated portion of their recruitment bonus if they decided to not go ahead with the JP Morgan conversion.
Wow, that's crazy. A lot of dynamics. As I said, this is a very, very sensitive topic. You do not want to be doing this alone. So if you are considering going RIA or joining another team, just give us a call. Us at Select Advisors on the client communication, website strategy, PR, all the things that you're going to need around branding. But without a doubt, Diamond Consultants, as far as all the legality that they could refer you to and all the different dynamics that goes into this very, very sensitive area of the markets that they are a dominant, if not the dominant player. And
Thank
so,
you.
Lewis, thank you so much. I will hyperlink below your podcast as well as that survey that you mentioned if you do have that.
Great.
And you guys can all reach out to him as you wish. So thank you so much, everyone, for joining today.
Thanks, Amy.
Thank you.